Well, folks, one of my stocks just absolutely collapsed. And I mean, an obliteration. Foot Locker's down 30% today. 30 flipping flapjacking percent. Just absolutely decimated. I want to speak about what happened here today with Foot Locker. What am I going to do with this stock moving forward? Is this a buy the dip? Is this a sell? Is this a hold? We're also going to talk about Bath & Body Works in today's video as well. That stock was collapsing. It has recovered over the past few hours, but that stock was collapsing on their earnings as well, which just kind of shows you, like, retail just continues to get decimated day after day after day. And so Foot Locker is an important dividend stock for me. And I mean, it's a position I'm just getting wrecked on right now, down $9,200 on this position today alone. After this massive crash was a $6,300 move down, right? Just epic. I mean, thank goodness my tech stocks are bailing me out, and Elf on a Shelf as well, because those are having a pretty good day. The $15,000 gain in Meta today, the $9,000 in Tesla, the $7,700 in Elf on a Shelf, and the $4,300 in Palantir should help balance things out a little bit here. But Foot Locker nonetheless getting absolutely wrecked here today. So let's go ahead and get into this. Let's talk about what's going on. I mean, this is getting really ugly and really scary for the overall economy. And this is something I keep speaking about day after day. Even yesterday I talked about it. We got to watch what's going on here, because this is starting to get to a little scary levels. Okay, so Foot Locker just reported their earnings. Right, total sales decreased 9.9%. Comp store sales decreased 9.4%. EPS loss of 5 cents. Non-GAAP EPS gain of 4 cents. Now the company's going through a bunch of restructuring right now, so in terms of their profitability being messed up over this next few quarters, that doesn't really come as a surprise to us. It's a little more of the guidance and a move they made, and also total sales. Lowering 2023 sales and earnings guidance, that's never a good thing to see. Pausing the dividend to enhance flexibility, oh boy. Now, what do I think about pausing the dividend? They're going to stop paying the dividend, and this is a dividend-paying stock. What I think about that is a disaster, a complete disaster. Like, the main reason people buy Foot Locker stock is for that dividend. I own the stock for the dividend. You don't see me owning that stock in my public account. I own it in my dividend portfolio. So when all of a sudden you're going to stop paying the dividend, that's devastating, right? That's absolutely the worst thing that can happen to you as a dividend investor. With that being said, when we're going to go through some of their numbers here in just a moment, you can understand why they're pausing the dividend, because things are a little scary. Let's just call it that, okay? Mary Dillon, the new president and chief executive officer of the company, she says, our second quarter was broadly in line with our expectations, despite the still tough consumer backdrop. However, we did see a softening in trends in July and are adjusting our 2023 outlook to allow us to better compete for price-sensitive consumers, while still leaning into the strategic investments to drive our lace-up plan. Importantly, we are continuing to make progress with our inventory levels. I don't know about that. And look to best position the business in upcoming holiday season and into 2024. Now, if Foot Locker's doing bad, that means Nike's doing bad. That means the rest of the folks that sell shoes are doing bad. So you're likely going to see Nike stock down big today, Adidas, Puma, any of those companies, and also doesn't bode well for a lot of the privately owned shoe companies as well. Look at this financial outlook. I mean, this is just bad. And remember, they just recently took down all their numbers, and so they're taking them down even more this quarter. This is a disaster, folks. Sales now are expected to come in even worse than they already thought they were going to come in, right? Comp store sales are expected to be down way more than they had initially anticipated, right? Licensing revenue is expected to be worse. Gross margins expected to be worse, which means they're going to be doing more aggressive markdowns. So if you need a new pair of shoes, you might get some deals over the next few quarters here, okay? Everything's just bad. I mean, it's just bad, right? Non-GAAP EPS, $1.30 to $1.50 expected. They were expecting $2 to $2.25. Now, if we go back just a few quarters ago, the company and folks in general were expecting $3 plus for this year. $3 plus. And now we're all the way down to $1.30 to $1.50 expected. This is awful. There's no other way of putting it, but just plain awful. Awful, okay? Now, And if we look a little bit deeper here, total revenues are down quite a bit on a year-over-year basis, 1.8 billion from over 2 billion there. Cost of sales hasn't decreased as much, which means your income from operations is going to get wrecked, which is exactly what happened. They have $1 million of operating income from operations versus 142 million in the same quarter last year. Net income came in at a loss versus obviously a gain of $94 million in the same quarter last year. That's not good, not good. If we look at the balance sheet, this is where things get very worrisome, okay? Look at this. Cash and cash equivalents, $180 million. That's versus $386 in the same quarter last year, right? Merchandise inventories are still a big issue. You got over $1.8 billion in merchandise inventories. That's versus $1.6 billion in the same quarter last year. That means markdowns are coming. That's just bottom line. When you see inventories that high, they're going to have to discount. They're going to discount, and they're going to discount, and they're going to discount. And that's going to mean lower margins, lower profitability, all those sorts of things, right? And sometimes that can steal sales away from higher end products, okay? So, what's my opinion, perspective, and then we'll talk about Bath & Body Works, then we'll talk about what this means for the overall economy in just a moment from all these retailers that just continue to just absolutely crash and just report these horrible numbers, okay? So, in my opinion, in regards to Foot Locker, is the stock a buy, a sell, or a hold right now? From my perspective, as hard as it is for me to say this, it's hard to say it's a buy right now. If you're buying for only two reasons and two reasons only. You're buying because of Mary Dillon, the woman I just showed you, who's a very proven executive, who's been in the workforce for a long time and has an incredible track record of success. Or you're buying because of kind of like a blind faith that the economy is going to get better from here, that the consumer is going to get better, and then all these retailers' sales will pick up, either at the end of this year or into next year, right? So it's a tough position, man, because as much as I want to be out there buying this stock today, I actually can't buy the stock today. And that hurts me because when I see a stock go down like this, I want to just, my natural thought process is buy. Like it's down huge, buy the dip, right? But damn, I don't have much positive to go off of from this report. They just slashed their dividend to nothing. They just lowered every single number in the book. Their inventories are way too dang high. And so I'm looking out there, and this is all during a time period of 3% unemployment. That's the scary part. I'm like, what happens if unemployment was 5%, 7%, 9%, 10%? What does that mean for Foot Locker? That's a scary freaking thing for me. And so I'm going to reassess. I'm going to listen to a conference call. I haven't even listened to a conference call yet. I'll listen to that, go through it, and try to figure out, is this one I want to buy the dip on, or is this one I just want to stay away from for right now? And so it's a tough position. It's a really, really tough position to be in when a company just comes in and reports that disappointing of a quarter. And this company was set up for such a freaking good, all they had to do was report one good thing, and the stock would have flown to the moon. The setup was so beautiful for Foot Locker, but they came through with everything being bad. It was a disaster on top of disaster on top of disaster on top of disaster, okay? Now, talk about Bath & Body Works. Talk about if that's an opportunity to buy here, or if that's another one to just stay away from. And then we'll talk about what this means for the overall economy and where we're headed here in regards to that, okay? So Bath & Body Works, they just gave their 2023 outlook. They updated it, okay? So the company has updated its full-year forecast to reflect better than expected bottom line in the second quarter, the impact of debt and share repurchase in the second quarter, and narrowed sales expectations for the fiscal year. For fiscal 2023, the company expects net sales to decline 1.5 to 3.5% compared to 2022. So Bath & Body Works, the company that sells soaps and candles, they're also bringing down their numbers. Now, there's a huge difference between them and a lot of these other folks that have seen a lot of weakness recently, because a lot of the other folks who have seen weakness, they might be at the higher end, the $100, the $1,000 price points, At the end of the day, Bath & Body Works, everything in that freaking store is under $25. So, yeah, not a great thing to see their sales declining as well, right? Company now expects full year 2023 earnings per share to be between $2.85 and $3.15. That was compared to $3.40 in 2022, so their numbers are coming down as well, right? And if you view this as a rolling recession, it's certainly rolling through the retailers left and right now, okay? Whereas last year it was really the tech companies were getting hit left and right. This year, it's these retailers, man. It is just bad. Company expects full year 2023 adjusted earnings per share to be between 280 and 310. The company's adjusted earnings per share forecast excludes a gain of early extinguishment of debt associated with the open market purchase and retirement of $199 million principal amount, right? And so that's good. Now, in terms of getting rid of some debt, right? But the interesting thing, back to Foot Locker, right, is let's say this is why it's so important that they had to cut the dividend. Because right now, do you want to take out debt right now if you're a company? No. I mean, interest rates are insane right now based upon anything you've had to pay in the past 20 plus years. So if you're a retailer, the last thing you want to do is have to take out debt right now, right? Which goes into the whole, well, let's just cut the dividend situation, right? Now, they have some big issues here at Bath & Body Works. Their direct business was down 10%, which is basically like their online business on a year-over-year basis. International business is down 4%, right? Stores are down about 1%, which, yeah, I mean, anytime I've been to any malls or anything, I mean, stores look busy, so it's not surprised that that's kind of, roughly about what it was last year. But the scary thing is, man, if that store traffic starts to drop off in any meaningful way, geez, what are we looking at for Bath & Body Works numbers, right? No, Bath & Body Works, $1.5 billion of revenue versus 1.6 in the same quarter last year. Gross profit fell to $622 million versus $660 in the same quarter last year. So the thing with Bath & Body Works, when you start going through these numbers, is it's not a disaster, but it's weakening. And that kind of reminds you of where Foot Locker was a few quarters ago. And it's like, oh boy, are we about to see a major, major weakness in a Bath & Body Works, right? Selling general administrative store expenses actually went up quite a bit on a year-over-year basis to $434 million from $418 million same quarter last year. That's not something you want to see, especially when your revenue is going down. Operating income fell to $188 million versus $242 million in the same quarter last year. Interest expense was in line. They had some other income there. Income before income taxes, $127 million versus $158 million in the same quarter last year. Net income came in at $99 million versus $120 million in the same quarter last year. And diluted EPS came in at 43 cents versus 52 cents in the same quarter last year. So, I mean, just to be quite frank, that's not good. Like, everything's pretty much getting worse for Bath & Body Works across the board. And once again, this is not a retailer that has to worry about taking out credit. You don't have to get a loan to go into Bath & Body Works. Like, you're going to spend $25, $50, whatever, right? And so it looks to me like Bath & Body Works might have to end up getting more promotional over this next several quarters as well. And if they get much more promotional, margins get hit, right? It takes away sales from full price products. So I wouldn't be surprised if you see a lot of Bath & Body Works bring back a lot of the old deals they used to do back in the day to incentivize customers to, buy a bunch of soaps at a huge discount and candles and things like that. So that's what's playing out there. And I also went by a Bath & Body Works store, a few weeks ago, and I actually took a picture of it and posted it on my Instagram story. And it was supposed to be just something funny, but it was actually might have been a little scarier than kind of thinking about it, right? I don't know if you guys saw that picture or not, but I posted this picture on my Instagram story of Bath & Body Works already had like Halloween stuff up, like the Halloween soaps and stuff. And we know like fall season is usually a huge selling season. So this was, a few weeks ago. So this was at the very beginning of August. So if you're pushing that product already out there at the beginning of August and not even waiting till September, October to kind of get that stuff in your store, the fall stuff, right? It almost shows that you're probably more desperate for sales right now to push out, your highest volume kind of products right now and let's get those in the stores now. That's a little worrisome in itself, right? And so, yeah, just, when you put these pieces together, and it's not a great situation, right? Now, in terms of Bath & Body Works, so the company trades cheap, right? Very cheap forward Ps. But once again, the scary part of this is Foot Locker has been trading really, really cheap. Why do you think I was buying Foot Locker stock? The forward P has been like in the 10 to 12 range. But when you just keep bringing down your numbers again and again and again and again, can you trust the forward P, right? And so with a Bath & Body Works, it's like, do we trust these forward Ps to be true? Or are these too high? That's a scary thing right now. And that's where you're really taking a risk in buying any retailer right now, because all these companies are just seeing their revenue start to decline, some of them declining faster than others, EPS going the wrong way, net income going the wrong way. And so when margins going the wrong way, so when you look, you're like, dang, man, or is this a bottom for these retailers? Or do we have a lot lower to go? Once again, I take you back to the scary part of we're at 3% unemployment right now. And so that's a scary thing that, is out there, that is like, man, what if we had an unemployment situation that got much worse? Does that hit these guys even worse, right? What if we had another problem with inflation, which based upon these retailers, if anything, it looks like deflation's coming, okay? Because at the end of the day, these guys got all too much inventory. They're going to have to cut price to move volume, right? Which is more deflationary than inflationary. These companies are not in a position of power. You can go through the whole long list of them, all the way from the highest ends Louis Vuittons, all the way down the food chain to some of the lowest end you'll get in a mall retailer, which is Bath & Body Works, where almost everything in the store is under $25. The whole food chain right now is pretty much in a situation where, if anything, they're going to have to lower price, discount to get consumers to buy rather than sell at full price. They're not in a position of power. There's nobody that's in a position of power right now in all of retail. Think about that for a moment. Let that sink in, right? Now, a friend and I were just talking about kind of the retail, and I just texted him this, actually, which was interesting. I said, man, these retailers are screaming of recession coming, basically, with their numbers. Macy's, Dick's, I even put Estee Lauder on there. You could put, even Louis Vuitton on there. Target, Foot Locker, Bath & Body Works, Home Depot. I said the only retailer that looks good at the moment is Walmart, and that's never a good sign. If the only retailer that looks good is Walmart, that's not good, okay? Walmart is like the needs place, the place of like, I need to get something as cheap as possible. I'm on harder financial times. Like, where did I shop when I was coming up in the money game in 08, 09, 2010, even 2011? When I got, after I'd even got my first job, where did I shop back in those days? Walmart. That's where I did my food shopping. That's where I went for everything. Because at that time, money was tight. And so I'd go to Walmart, right? And then as I grew my wealth over the years, I stopped going to Walmart. And I don't even really go to Walmart nowadays unless I need to go there to look at a specific product. I need to see, like how it looks in a Walmart store or something like that. And so I'm just telling you, if the only retailer doing well is Walmart, we're in something. Let's just call it that. If you don't want to call it a recession, you can call it whatever you want, but we're in something if the only damn retailer that's doing good is Walmart, okay? So let that be some food for thought out there, folks, okay? This is why I've been talking about hedges for a while now. That's why I've been talking about cash levels, because, these things are adding up, okay? These things are adding up, and we're still in a very low unemployment situation. If that changes, that's the next leg lower. So let's hope that doesn't change. But if it does, that's when we take another leg lower there, okay? Appreciate everybody joining me as always. Thanks so much for being subscribed, folks. Much love, and have a great day.